Hey everyone, welcome back to Corporate Decoder. Today we're diving into the financial report of AppYea, a company focused on wearable tech for sleep apnea and snoring. This report is a bit like a late night infomercial, full of promises but lacking some key details. We will find out if they can actually deliver. AppYea filed their annual report, also known as a 10-K form, with the Securities and Exchange Commission. This report covers the full year of 2024, so let's see how they did. First, the basics. AppYea is a company based in Nevada, but their tech development is primarily in Israel. They're trying to crack the market for sleep apnea and snoring solutions with wearable devices and AI. For those interested, their SEC file number is 0000555403. Just in case you want to do some digging yourself, they're considered a smaller reporting company, which means they get some breaks on how much they have to disclose. This can make finding the real story a bit more challenging. It's a standard annual report, which means it's a look back and not a transition report. The report confirms they filed all required reports over the past year and submitted their interactive data files electronically, which is good practice. They were incorporated in Nevada and make use of a phone number with an 800 area code. As of April of 2025, AppYea had about 534.8 million shares of common stock outstanding. But here's a key figure. The market value of stock held by non-affiliates back in June of 2024 was only around $6.8 million. That's not a huge number, indicating the stock is not widely held by the public. The document is pretty standard with the table of contents. Now we get to the forward-looking statements. These are essentially disclaimers that say, hey, we're making predictions, but things could change. A lot of the forward-looking statements, like the ability to get regulatory approvals, depend on if they can get the cash they need. For 2024, they lost over $4 million compared to about $1.8 million the year before. Their accumulated deficit also ballooned to over $10.3 million. Their ability to continue depends on them raising more funds. Next is the license agreement, in which the company derives from a licensing agreement that they signed. They will need to pay a certain percentage of sales for 15 years. They talk about the competition in the treatment market, which includes all kinds of products from nose cones to tennis balls in the back. They will need FDA approvals in the future, and they lay out how those approvals can work. Now we get to the fluffy part of the filling. We can skip that. The risk factors, always a fun read. Number one, they might run out of money. If they can't get funding, they might have to shut down. Certain note holders have a security interest in basically everything they own. That's not ideal and increases the pressure to pay them back. There's also a lawsuit involving SleepX and some related parties, alleging a breach of partnership and some shady dealings. This is transferred to an economic department, so could have legal impacts. They point out that for a company to succeed, they will depend on a bunch of points, including managing expenses, following regulations, etc., which are generic to all companies and not very insightful. As with any company these days, cybersecurity is a risk. If they have a data breach, it could be bad. They have to comply with all kind of healthcare regulations to prevent fraud. Since much of their work is in Israel, political and military events can have a big impact on their operations. Many employees also are required to go on military reserve duty in Israel and may impact production. This company is a penny stock, so it's going to be complicated for people to buy it since regulation limit the activities of broker-dealers affecting transactions in penny stocks. Some new pronouncements by the SASB, the Financial Accounting Standards Board. Now let's look at some numbers from their financial statements. These numbers are presented in thousands of dollars, so we have to add 000 to the end. Research and development expenses increased to $339,000. General and administrative, however, decreased to $114,000. Here's the scariest number. They only had $79,000 in cash on hand at the end of 2024. They had liabilities of over $4.5 million. They burned through almost $800,000 in operating activities during the year, which is quite the burn rate given the small cash pile they have. They are manufacturing in China and planning to keep 3 months of stock. They admit there is substantial doubt about their ability to keep the company going in the future. They admit their internal controls aren't effective. This is never a good sign. Some directors and officers forgot to file the correct forms with the SEC, but this is not too big of a deal. The summary compensation table shows how much the top executives made. The amount are not really impressive for public market companies in the US. This is all paid to the leadership, which includes the executives named in the report, which includes Boris Molchadsky, the chairman and chief executive officer, Adi Shemar, the former chief executive officer, and Asaf Porat, chief financial officer. They don't have a code of ethics, small and not enough reasons. Their key strategy relies on the founders and their plans. Most of the administrative expenses, what they pay their employees and people who work for them, are all paid in non-cash and more in shares of the company. This is not bad or good. Since they operate in Israel, anything bad in the Middle East will affect them. If regulations are too complicated for them, they could shut down the company. Their medical devices are subject to tons of FDA regulations. Since the financial statements are incorrect, they are not paying people based on performance. And also this might be a reason why their internal control is ineffective. They are also too small to do it with their limited resources. One board director, Ron Meckler, is considered independent, which means he has little connections to the company or its day-to-day activities. Finally, we get to the exhibits. These include the list of subsidiaries and also certifications from the CEO and CFO about the accuracy of the report. They need to pay people. The show is not worth paying. If the board isn't managing these, then the investors are in for a big surprise. The filing ends with the signatures AppYea. Now let's step back and look at the bigger picture. AppYea is in a tough spot. They're burning cash, heavily reliant on raising more funds and facing legal challenges. Their internal controls are weak and much of their executive compensation is tied to stock, which can be good if things go well, but risky if they don't. The company needs to prove its technology works, navigate the regulatory maze, and find a way to fund its operations without diluting existing shareholders too much or taking on too much debt. It is definitely a difficult path. The biggest risks here are running out of cash and failing to get regulatory approvals. They operate in a very competitive market. However, if they can get their products approved and adopted, they have a chance to carve out a niche. This is still a big if, set the heavy reliance on a small number of people, and a founder at that means they would need to start expanding their circle of expertise and board member to reduce the concentration risk. I think in conclusion, AppYea faces a difficult and uncertain path. Thanks for watching. If you found this Corporate Decoder episode helpful, please like, comment, and subscribe for more deep dives into the world of corporate filings.